Good afternoon, everybody. Going to go over our trades for today, Tuesday, December 1st. Decent day. 3 trades, pulled out 15.2 pips on a size adjusted basis. We'll go over them in a second. First, the economic news. Big news out of Canada. Their GDP contracted. Was supposed to come in at zero growth for GDP. Came in at a negative 0.5%. So that's obviously a recession level. And their recession seems to be accelerating over in Russia. U.S. manufacturing PMI came in pretty much in line, although that in line was in line with estimates. That in line number was the lowest since October of 2013. U.S. ISM Purchasing Managers Index came in below estimate. It was supposed to come in at 50.1, came in at 48.6, so that missed. The ISM Manufacturing, that collapsed to the worst level since June of 2009 as new orders and prices paid both plunged. The last time ISM Manufacturing was at this level, the Fed had just started QE1. So go figure. Here, the Fed wants to raise rate. They ended QE. All the quantitative easing. They want to raise rates. They've been putting it off. They put it off September, October. Was there a meeting in November? I forget. And then December. Now all eyes are on. I guess it's December 16th that they're going to raise rates, and there's all the signaling that they're going to raise rates. Yet ISM Manufacturing collapsed. And the last time it was at this level, they had just started QE. So it's almost like it's a comedy of errors what's going on. All central banks around the world are doing a stimulus program of some sort. Quantitative easing, whatever it is. We have ended ours and want to raise rates. We're going against all other central banks. Now, do I believe we should have higher rates? Absolutely. Do I believe we need to normalize them? Absolutely. Do I believe we need to do it because the economy is so good? Absolutely not. Should we do it even though the economy is not good? But at least admit why we're doing it. We're not doing it because the economy is good. We're doing it because we want to, because quantitative easing isn't working. It doesn't work. It's a failed experiment. Be straight up with the American people. Be straight up with the politicians. They don't know, right? Those people in Congress, they're as dumb as a bat. So they don't know what's going on. And they're all, led by the nose by Janet Yellen and the Fed. So the Fed should just be honest, say, look, QE doesn't work. We've tried it for all these years. We've spent $4 trillion doing it here in the States, over 20 some odd trillion around the world. It doesn't work. It was a financial experiment. We had a hypothesis and it didn't come true. So let's move on. We need to normalize rates to create good inflation. The little bit of inflation we're creating is not good inflation, does not create jobs. Would the economy take a hit? Probably in the short term. Will the stock market take a hit? Absolutely. But get it over with. Do it. I'm not going to do it all overnight, but you do it. Do it in a slow, steady pace. Normalize rates, create good inflation, create an incentive for investors to want to buy a muni bond, a treasury, not getting 2.5%, 3% on their money on a muni bond, getting 2% or 1.5% on a treasury, depending on what years you're buying. Give the investor an incentive to buy a muni bond yielding 5.5%, 6%. Now the municipalities have cash flow coming in to do different jobs and whatnot. That's just at the public sector. I'm not even talking private. So, but whatever. They don't. They obviously aren't. They aren't down on that page. They want to BS everybody and say everything is so rosy and great out there. Goldman Sachs did come out with a piece saying that they do not expect the prolonged or deep period of contraction in the manufacturing sector to last. That was one good thing, but that's just a guess on their part, of course. But they are Goldman Sachs. The Atlanta Fed just came out literally 20 minutes, half an hour before we did this video. Atlanta Fed came out and slashed the fourth quarter GDP forecast from 2.3% to down to 1.4%. So another terrible indication. and this is by the Atlanta Fed. That's their model. They're the Atlanta Fed GDP Now computer model, which is very accurate, by the way. It is volatile. It can move up and down. It gets updated every 2 weeks or so. But they just dropped it by what, 6, 9 to almost a full percentage point. So not a good thing there at all. There was something else. There was a story last night came across by Blackrock, which is a huge hedge fund, and they were saying that it's kind of encouraging. They were saying that when volatility picks up, which they're expecting it to, because there's so much uncertainty. QE doesn't seem to be working. The Fed wants to raise rates. Other central banks are lowering. A lot of uncertainty. Uncertainty creates volatility eventually. So we've been in a very low period of volatility over the last few years, especially intraday volatility. Overnight volatility, maybe not so much, but intraday volatility, it's lower than it's been. They came out with a piece saying in times of low volatility, it's harder for active managers to outperform the market. Okay, so, and we're definitely active managers. We're in and out. We're not investing long term in our positions. But when volatility picks up, those active managers seem to outperform the market. They get more action. They get more trades, and the volatility is there for them to capitalize on. So definitely some encouraging words from Blackrock. Again, like I said before, they're Goldman. This is their Blackrock, right? They're one of the largest hedge fund, mutual funds, whatever exactly they are, in the world. So, and they swing a lot of weight. Those are the guys that were very much in tune with all aspects of market: bond market, stock market, currency market, treasury market. You go on right on down the line. Okay, so let's get to our trades. 3 trades, pulled out 15.2 pips. One full scalp, the other 2 were 20% of normal size. First one you're looking at here was a short in pound yen, 185.565. We had 20% of this. Came in nicely. We missed an opportunity to cover down here. When it came back down again, we took that opportunity. We covered, picking up 41.4 pips or 8.2 on a size adjusted. You can see what it eventually did. It really came down if we were wanting to hold it longer. Our stop was upwards of about 186.30, so it really didn't approach it. It stalled out at 186. But we'll take that trade anyway, without a doubt. Second one was a full scalp last night, short from 185.235. Again, just real quick, in and out. Not going to look to piece out or anything. You're just going to make whatever you can, 3, 4, 5, 8, 12 pips, whatever the number is. Not going to risk more than 15 or 20, maybe 30 tops. We covered 185.187, picking up 4.8 pips. You can see what it did. It did spike all the way down to 185, about 06. So I guess we left some on the table there. But again, they're moving fast. That's a full scalp. You're just in and out. Pound dollar. We were short this 20% of our normal size from 1.50857. Actually got hit late last night, and you can see what it did. We had our stop up much higher than this, upwards of 1.5150, I believe. Yeah, right around 50, maybe 60. So it didn't approach it. We came in the office this morning, and we had a profit target in here of about 1.5060, I believe the number was. And when we came in the office, it was trading around 74. We were up 10, 11 pips. We knew there was a bunch of data coming out this morning from Canada, a whole bunch of others from the United States. So we figured, let's just take it. Let's just take the profits and run. We had the other 2 pretty decent trades that were closed out. So we took it off the table at 1.50747, picked up 11.0 pips or 2.2 on a size adjusted basis. So that's it. We're going to wrap it up. If you're still trading now, good luck. If any signals come out, they'll be coming your way. And we'll be back tomorrow, assuming we get some action tonight and tomorrow morning. Have a great rest of your day.